I don't know why that's about to. All right, I'm gonna call to order, what day is it? July 16th, 2026. February 27th.
Yeah.
I don't know what was going
That
on.
was a fun day.
Note the presence of all retirement board meeting participants. Let's see everybody here, right? All right, I'm gonna have our treasurer lead us in the pledge.
I pledge allegiance to the flag of the United States of America, to the republic which stands one nation under God, indivisible, with liberty and justice for all.
All right, do you have anyone to public comment? No public comment. All right, I'd like to make a motion to approve the April 23rd, 2026 meeting minutes. Do I have a
So moved.
so moved?
Second.
Second by Commissioner DeBello, all in favor?
Aye.
Aye, motion carries. Hey, Kathy, hold up.
Good afternoon. How's everyone today? So I was told to be short and sweet, which is very, different than the other meetings. I know you like to hear more. And the actuaries are following me, so
Yep.
and I believe they have great news.
Yeah.
So, I will keep it short.
You know how they are. They go on.
They love to go
forever.
on forever. I'm the fast talking Northeast girl. So I'll start right off on the executive summary and we can just give you the important points for the quarter. So you can see on this page, I have the beginning market value or the end of market value 2025. I kept the first quarter information in here because I think it's very noteworthy that we were down for the quarter just about less than 1%. But the good news is we're back up to $801 million with a quarterly return of over 8%, which puts the year-to-date numbers at 715. So, and I looked at the market value as of yesterday, we're pretty much flat. So the good news, we're continuing that momentum, which has really been beneficial in some of the numbers that you're hearing from a funding standing perspective. But the shift this quarter was really a powerful recovery. Again, we saw March with the outbreak of the Iran conflict, what really happened. But we had a strong quarter and it was really led by spending in artificial intelligence. And what's unique, what we saw this quarter is it's really shifted from those mega cap names into infrastructure and semiconductors. And it's all about memory and hardware. And we're really starting to see that shift. What is also notable is that we saw areas, again, we see this broadening of the equity market. We saw areas like small cap and emerging markets. So exceedingly well, both areas were up over 20%. Emerging markets were up 24%. So again, but if you dig deep into the data, what I think is really shocking is it's heavily focused and concentrated. So for example, the emerging markets that were up 24%, there were 3 stocks that were up 170%. The SK Hynix, Samsung, and I'm drawing a blank the last one. It'll come to me. 3 semiconductors. If you take them out of the index, it's pretty much flat. So very highly concentrated, 30% of the index, Korea and South Taiwan. So really, really heavily focused there. If you looked at the fixed income market, we didn't have as strong as a rally. And a lot of that was due to shifts in expectations on Fed. We started the year with expecting the Federal Reserve will cut rates twice. It really blew out during the quarter that we might get a rate increase. We saw inflation really kick up, and a lot of that was due to oil and energy. So a pretty mild fixed income quarter, and it continues to remain that way. Other areas within fixed income did better. High yield emerging market debt did add some positive value. And then finally, your alternatives had a strong quarter. I have more recent numbers. They continue to benefit the portfolio and provide the role of being uncorrelated and differentiated sources of return. So do you want to skip all the market and outlook and do a right to performance and then have these guys come up? I'm getting nuts. Okay, we can skip all that then. Yes?
Sure.
You like it? What's like?
This is my expert briefing on what's
Okay.
happening in the world.
So maybe 5 minutes, 4 minutes?
Yeah, it's fine. I just have to get my kids.
Oh, well, that's kind of important. So you can just see on this slide, we have really strong quarter across the board. You can see the blue. Again, I mentioned before, small cap over 20% emerging market, but we still saw large cap and world equity really play out strong returns. Again, across the board, fixed income positive. I think what is noteworthy, you see commodities are down. We saw a big increase in oil for the first quarter. We saw that pull back with confidence of a resolution. So you saw commodities got hit. And then finally on the next slide, and then I'll end the market review there. And if there's any questions, I can go deeper. We had talked about fixed income, and what I think is, we talk about this every quarter, the US yield curve. What's so interesting, if you see that blue bar on the lower left-hand side, we continue to see a rise across the yield curve of rates across the board. And if you look at the shorter end, specifically the 2-year, that's very reflective of anticipation of what the Federal Reserve will do. So again, we went from the market's expecting 2 cuts to possibly 1 hike. So you saw that pretty much raise across the board, even on the longer end, not as strong as a rise, but rates are really remaining elevated, which limited your ability for fixed income returns, at least in treasuries. But again, markets are pricing in higher inflation, more risk to increases than cuts in the past. And then you can see the option adjusted spreads on the right-hand side, which really reflects tight spreads, risk taking, but definitely benefited the portfolio for the quarter. So the next slide, just, I'm not going to go through this because this could take a little bit more time, but I'm happy to give any more, information on an outlook. In just one sentence, we are expecting in a reflationary environment, a more sophisticated, complex reflationary environment, which really means when you look at reflation, it's strong US growth with inflation. So we're seeing that even though we got lower inflation numbers this past month, there's a few things happen. There's supply, constraints and oil disruptions that are causing inflation. But there's also AI infrastructure and hardware and spending that is having this pull. So if you think about memory and chips and supplies, they're shorthanded. So we're all seeing that if anyone's interested in buying a phone or a computer, they're all going up in price because the supply is limited. So we're not only seeing supply disruption, we're seeing demand disruption, and how you solve that will really big out in productivity. If we have productivity, which we're expecting, and that's SEI's outlook, that productivity and that equity is going to expand into old economy names like industrials and metals and energies. You think about data centers and the need for electricity and all these, metals, you're going to see all those other areas within the market expand. So I will end it there, again, to be respectful for Jamelia and for my fellow presenters.
They can stay.
You
So
have-
go.
you have to
Okay.
leave? You have to
I think it
leave?
might get not till like 1:40.
Okay.
I just need to-
Okay. So then I'll just hit
Yeah,
the performance and then you guys could do the evaluation. So if we jump to any questions on the outlook or any of those data points, please. Doing great.
Like, okay, you're talking about the outlook, but so you hit a couple things you hit on there actually was falling. But what other predictions are you guys looking at or thinking about for the back half of this year?
Yeah, so there's a lot. One, we're thinking the US dollar is going to continue to strengthen and US markets are going to do well. We're seeing China struggle. Their GDP came in lower. We were really positive on emerging markets, which have done well and still have potential to do well, but it's very concentrated. We do think rates will be higher. Not expecting a lot of increases, but maybe one. Again, I think a lot's going to play out in how we're looking at inflation. We had a good report in June, but the data's in the details of the next few months. And with the on and off, conflict that we're seeing today, we're seeing oil prices go back up. So you're still seeing some sticky, I guess the best way I could say is sticky prices, inflation. Again, we're, thinking that the equity leadership hopefully will broaden out. So industrials, those old economy names, I think will be very important. The mega cap, names are kind of done well, but now when you look at all the spending that the new economy and technology has done, it's really going to be the others that aren't spending as much that get to benefit from it. Every industry is going to benefit from AI. So it's really going to be interesting to see how that plays out, but there's risk. Could there be a bump in the road with AI and spending? And of course, we've seen the highs and lows of that. And the concentration, there's risk with the war right now, what's happening, will oil prices go back up? What does that do? But overall, we are generally, positive risk assets, but with more focused. And again, there's probably some more volatility and that we're going to see for the outlook, but generally optimistic. And then even within fixed income, if you have rates higher for a little bit longer, that impacts where you want your fixed income investments. And then inflation protection is really important. And we do have that a little bit.
Right, because we've seen a gain of what, a little over 100 million from last year in the
Yes.
fund. So it's really it's talking about protecting that through the back half of this year.
Okay. Yeah. Yeah, I think, we were just talking after next year, your 2022 could roll off potentially, right? And you're,
That's the whole other story,
and
right?
which is great. But yeah, so you want to finish the year really strong. I
Right.
mean, you clearly have a portfolio that's return enhancement focused, which you need in your, it's for the long term for growth. So that provides a little bit more risk. But the good news is, and we always preach this, diversification across asset classes. So not only diversification, we saw international do better than US, we saw small cap do better than large. So diversification within equity, but also within sectors within equity, given that concentration risk with AI, diversification within fixed income. And then you have two alternatives. You have a hedge fund that had its best quarter ever. It was up 9%. It's not in the books. That's uncorrelated. It only has a market beta of 40%, which means it's very uncorrelated to the US equity market. And that's what you need. And then you have a fund that has some commodity exposure, some currency exposure. So when you put that together, that's going to get you through some of these bumpier periods, right? So you could say, other than going and de-risking and going more conservative, which we wouldn't recommend.
No, yeah,
There could be some more volatility ahead, but it's really the strategic asset allocation that's going to hopefully get us through, some of the bumpier times.
well, I guess what I'm trying to say is, we want to go in protective mode, but we don't need to get conservative,
Mhm.
really conservative passive.
Right.
Also, so it's kind of balancing that.
It is balancing. Yeah, we don't recommend a change unless you tell me your goals are changing. We understand the importance of kind of locking in a good year, but our strategic asset allocation for the long term, it served you well in the past. That doesn't mean we couldn't get a pullback
Right,
if certain things happen within the market, but it's been extremely resilient. We're seeing consumers spend,
yeah,
growth,
consumer
earnings,
spends, yeah,
employment's hanging in there. Consumers are spending, earnings are off the charts. A lot of positives, and even geopolitical issues have not really disrupted severely the markets. So a lot of positives, but I think this AI trade, this extreme massive amounts of spending in infrastructure, think of all the downhill, electricity, utilities, cooling water for data centers is really kind of the next leg of where you're going to see some productivity. And SCI's perspective is we invest in companies that are earnings generated, value, areas that we feel could benefit from some of this upfront investment. And that's kind of our, point of view.
One,
Yeah.
one question. So much of the conversation about whether we were in a bubble, I mean, for like the last 7 years or however long this has been about how the tech companies are overrepresented in terms of the S&P
Mhm.
and the growth. And now that doesn't seem to be the case because they've gone down and S&P's gone up. What does that mean? And is it mostly just the memory and the infrastructure pieces that you're talking about? And, Meta, for example, everyone says they're going to spend $1 trillion on data centers, but they said that they're going to be renting their data centers if they overbuild. Isn't that a sign that they could be overbuilding and that this is going to come to an end? And wouldn't that be the pop?
Yeah, so a few things. Back concentration, the S&P 500 still heavily concentrated in technology. Technology represents 30 to 40% of the names. So we're heavily concentrated there. Concentration in emerging markets, I just told you 3 names alone were responsible for all the earnings. So now you're seeing semiconductors be the concentration. Semiconductors had the best quarter that it's ever had, ever. The index was up, I think, 80%. And that continues to bounce around a little bit. So there's concentration risk. I think the concern now is all the spending the market's trying to digest. And that's a really good question. I wish I had a complete solid answer for you. Market's trying to digest, is all that spending going to be productive and lead to revenues? And it's so forward looking. The market right now is accepting that it will. And again, as I mentioned before, there's other areas of the economy that will benefit from all the spending of those hyperscalers, and they don't have to spend as much because they'll be the reward. But the issue with Meta, I believe, is, The challenge is getting places to build these data centers, right? And, I think New York is pausing, and you see many, cities and countries or cities and states are pausing concerns for data centers. If you don't have the data centers, you can't build the infrastructure to have the technology. So I think that's it. So your question, I guess, I want to make sure I understand, because Meta is renting
Or
spaces.
is it a signal that they've committed too much, right? And other, because if all of this is built on we're spending trillions of dollars and now actually we're not going to do that, or we shouldn't do that, or we've
Right.
done too much, then that would.
Yeah, that could be a reflective of kind of concerns with their balance sheet. I think what you're starting to also see a shift is in debt. So instead of, there, a lot of these, which have been great, a lot of these hyperscalers have had the balance sheet, have had the strong earnings, and have had the money to spend. Now it's shifting to, do we take on more debt? So I believe that's Meta just kind of saying what makes sense for
Mhm.
our balance sheet and our stock going forward. Does it make sense to spend, or does it make sense to rent? And really, where are we going to use that money going forward to be productive? Is the best way I would probably translate that. Is that helpful?
Appreciate it.
Yeah.
Yeah. There's no one.
Wish I had the answer, but
no.
I think, we're seeing it broadening out more
Yeah.
than what we've seen, which is good news, but you're definitely going to see those spikes. And until memory chips come easily and the demand decreases, you're going to see that continue to be price inflation as well as doing well. And again, you'll get pullbacks when the market hears bad news from a company. You'll definitely get those pullbacks, and it'll be probably a little more bumpier than we've seen. All right, I'll just finish it out for my short segment with performance and then hand it over. So on the next page, please, is just the I'm sorry, the next page. So you can see for the quarter or the year to date, 53 million, to Tom's point, over 110 million for the 1 year. And then the next slide gives the high level performance, up 7.15 for the year to date, over 8% for the quarter. I won't go through the details, but you can see equity was a huge contributor, contributing over 12% year to date, and fixed income a pretty flat, still adding value from a risk management perspective, but not really getting your gains. And then the next slide shows continuation of fixed income. Your alternatives on here, I spoke about them. The numbers aren't on here. Your special situations fund was up 9% for the quarter. That's lagged. Again, one of the best quarters for the fund. So that continues to add value. Dynamic asset allocation fund is that fund that has commodities, has inflation protection. Didn't do as strongly. We had exposure in emerging markets, which was beneficial, but we also had a point of view that the short end of the yield curve would tip a little bit lower, anticipating rate cuts. And that trade did play off this nicely, but it's very good exposure for your portfolio. I will end it there unless there's any questions. Great. Okay. Thanks, everyone. Thank you.
Thank you.
Okay. Next up. Appreciate it.
All right.
Sure.
So in front of you, you should have our slide deck. The
Great.
short version up on the screen is our long, full report. If you need to reference that at all, we can talk about that.
Okay.
But we were told, yes, to be brief today. So we're
Yeah,
gonna go through this
We're
pretty
excited for this
quickly.
Presentation. We're excited for this.
Great,
presentation.
yes, so are we, so are we. So I'm gonna go through this slide deck quickly.
Okay.
And then if you have questions, we can touch on those and reference any other material we need from the actuarial side. So I'm Michael Savaro with GRS. Chris Seats handed out the presentation to you. He's in the back. We work as the actuaries on the plan. And as a reminder, what we're doing here is we're doing an actuarial valuation that we do every year. That basically just measures everything and trues it up from year to year. So I'm on slide 4 on the slide deck. That's where I'm working from right now. So basically we want to see what happened in the past calendar year. So in calendar year 2025, what happened with the assets, what happened with the liabilities, how do we value each member in your plan? What do we expect their benefit payments to be in the future? And then boil that all down to a couple key numbers, one being the funded ratio. So that's going to be one of the big measures we look at, where how much assets do we have held in the trust versus how much liabilities do we have earmarked for all those members in the plan. And then an actuarially determined contribution, or that ADC for 2026. So you're excited. The outlook looks good. So I'll say that in advance. Asset performance was very good, and we had some demographic gains, meaning we have assumptions in the future, and we didn't meet those assumptions in a good way, meaning people didn't get as high pay raises maybe, or not as many people retired, things of those nature that would trigger benefit payments that come out of the plan. So that's going to lower your liabilities, make the funded ratio better. So that's the big overall picture.
Really quickly, is there an issue that what he's describing then is not up on the screen? Because if somebody goes and looks at this meeting, he's going through a presentation. That's, I'm just double checking, because we're not showing that presentation, because I don't think she has it.
Oh, that is not
Yeah.
being shared.
Could it be
Sorry,
shared?
I didn't realize.
We sent it on. Steve, I think we sent it to you on Friday, right? Did you forward it along, or can I forward it along to?
I'm just thinking if somebody
Isn't
looks at
that
this.
decisional action being taken on it, so we can go forward and make it available afterwards, but best practice would be if we have it.
We have the
Okay.
physical
Oh, yeah.
copies of the presentation.
Yeah, that's,
I can also work off this if we want to do match the screen.
it's fine as well. I mean, I just,
Yeah, I mean, so he's giving the report publicly, so.
okay, that's fine.
For transparency purposes, it's okay, but we should have a copy. Be able to make sure that's shared.
All right, go ahead.
All right, so stick with the.
Stick with the presentation.
Yep. Short version, got it. All right, so I'm on slide 5 of our presentation. For those with paper copies. So when we come up with an actuarial determined contribution, there's 2 main components. There's the normal cost, which is, I consider your upkeep. You know, you have active members that are accruing service throughout the year. You want to pay for that service as it's accrued. So that's part of your ADC and contribution each year. And then there's the amortization payment, which makes up the shortfall. So there's mechanisms within this funding where if you are short, which most plans are, where you have assets that are lower than the liabilities that you have booked for the plan, there's a contribution to get you closer to 100%. So each year you're making a little bit of that, like loan payoff, essentially, is one way to think about it, to make sure you are tracking towards 100%. So those are the 2 main components. One of the big things to consider when we look at this is we utilize asset smoothing on the asset side. So we touched on that with the 2022 base that's coming off soon. So we use this method of 5-year smoothing, which is really common, best practice. And what this plan uses, where each year there's going to be a gain or loss. We're not going to hit the 7.5% assumed return spot on. And what we do is we say, okay, 20% of that we're going to take right away, factored into our ADC, then 20% the year after, so on and so forth, until it's fully recognized. So our smooth asset value is always tracking towards what actual asset performance is. So theoretically, they would match if we hit the assumption every single year. If that explanation doesn't make sense, I know slide 7 makes sense more to me when you look at it visually, where we break down and we say, okay, well, what was the market value of assets? So that was what was actually in the trust each year when we did this valuation, and that's that red line. So that red line, you see, it's a lot more volatile. There's ups and downs, peaks and valleys kind of thing. But what we calculate your ADC on, which is really just a budgeting tool, where we're saying, hey, how do we spread this contribution out as evenly as possible over time? We contribute on that green line. So that factors in that asset smoothing. So a lot better picture for you, because if we contribute on the red line, those ups and downs, your contribution would be all over the place. So this is one of the tools we use and like to highlight. So it's doing exactly what it's supposed to. That green line is cutting through the red line. So sometimes you're going to have market value of assets that's above what we're using in the valuation, sometimes below. And as we noted already, the 2022 base that occurred, there was a big loss that year, and that's had a drag on the contribution and the funded status of the plan, but that is coming off next year. So next valuation, hopefully it's the last year we're talking about that. And things look good going.
Wait.
All right, so then I'm gonna jump right to the results on slide 10. So we have a side by side of our last valuation that we did as of January 1st, 2025. That is the rightmost column. And then that middle column is the 2026 valuation. So the current one that we're talking about and discussing. So I mentioned there's two main components. There's that amortization charge, which was $22.3 million. So that is a contribution towards getting you closer to 100% funded. Then there's also that normal cost, which we offset by money from the employees coming in as well. So that was $19.8 million of normal costs that participants accrued, offset by the 11 million approximately that we expect members to be paying into the plan to get your net contribution to $31 million, which is lower than the previous valuation we did. So if you look to that rightmost column, you're at $32.5 million last year is what we calculated. So we're heading in the right direction, stabilizing, which is kind of what we would expect as you're making contributions. Asset returns are very positive right now, a big contributing factor to this and coming into a more stable period. And then that bottom line numbers, that funded ratio, that's the other one I talked about that we look at 80.2%. Last year we were at 76.9%. So a big jump again, asset performance really well, some demographic gains that helps boost that number a bit. And then the last slide I'll leave you with is the next one, just another visual history of what the funded ratio has looked like. And there's some story that goes along with this because, you know, we were up at 87.8% 10 years ago, and we're at 80.2% now. And that's not the direction you want to trend, obviously, the way we have this set up. We're trending towards 100%. That's the goal. But all it takes is a few bad asset return years, a couple demographic losses, like I believe there's been pay increases recently at the county that will increase those liabilities. But the important part to us is what is the trajectory going forward? So where we're at, we see this going in a positive direction. You see that funded ratio tracking a little bit up and stabilizing. You see that contribution stabilizing. That's what we want to see. We're just trying to contextualize and understand what happened previously. That is all I have prepared for that slide deck.
Could I, quick question, could you go to slide not like page 9 or slide 9?
Yep.
I'm just trying to understand that one.
That is demographic information, correct?
Some remember it.
Yep.
Yeah.
So we can talk about it, or do you have a specific question? Or?
So what are we trying to show though? Just start at a high level.
Yeah, so we always like putting this in a slide deck so that you can look at it and see what your member population looks like year to year. You know your members better than we do as the actuary. We get data at one point in time. So we like to at least display, okay, does this look about right? You know, does it look like, and it's not the case here, but sometimes there's some volatility in counts of members. And it's like, okay, well, if we had a lot of terminations at the county and we have vacant positions that need to be filled, we would expect that number to be lower. So we don't see that here. It looks really stable to me, you know, plus 24 people on 2,700 is really stable. And you look at the pay, you know, the average age and service, that all looks really stable. But we just like to put it in there to make sure there's nothing that looks like an outlier to you. Because one of the big things we always talk about is bad data in, bad answers out, right? So if we're not getting the correct demographic data into our system and into this valuation, the contribution and funded ratio that we provide is not going to be as accurate.
So in the middle of the slide, then where it says beneficiaries, that's the number that's showing the number of people that are receiving pension.
Yep.
And then the 49 million is the payout out of the system. Is that what we're saying?
Yeah, exactly.
And then what was the
Bottom number, the vested members? So those are members that are not currently receiving benefits. They are not active employees. They're not getting more service. They're not a county employee currently, but they are owed a future benefit. So we keep track of them. So when they turn age 60, they can come in and start collecting their benefit, let's say. And we hold a liability for them because they have a liability. They will be paid out of the plan at some point.
right? But they're not the 40. So the 49 million is that's not actually played into that. So the 49 million is the actual payout.
Correct. That's the roundabout number that we have in our system from the data we have that says these are the people that will be paid out.
But you-
So it will be higher when inevitably those 463 people come to collect at some point.
Where do you show, I might have missed it then, where do you show the actual injection of pension payments from the employees?
So that one we can reference the full report.
Oh.
So that would come from the asset information that we receive of what were the payouts in 2025.
Well, I'm just curious what payouts versus, injections in from,
Oh, so like a cash flow
Yeah.
standpoint. Yeah, so on our report, if you go to page 3, this is our asset page where we have a reconciliation of everything. So what I'm seeing from 2025, $51.4 million. I know that's really small to see. In deductions, so that's your benefit payments, that's administrative
going in.
expenses, those kind of, that's
Right.
coming out of the plan. And then coming in, almost $47 million between the county contributions and the members, what they're paying into the plan.
So what's going in is slightly, would you say about 3 million, 4 million less than what's going out?
Yeah, like it's like 5 million.
But yeah, 4 or 5 million going out higher
Right.
than what's coming in, which is not atypical for a plan of this size and
Right.
maturity.
Well, yeah, I actually was curious of I wanted to see what the difference was. I wasn't.
Any other questions
Thank
for
you.
us on the actuarial side?
Any questions?
Great, short and
Thank you.
simple.
Thank you, appreciate it.
Well, so. Are you gonna, maybe you're gonna do the next, you're doing the next part?
No, we're finished. I was just gonna give a couple comments related to, but is there another question or?
Well, I'm just gonna, I know that we've talked about this in the past, and so I thought I'd touch upon it where, that 80% number, the golden 80%. Was that, because we've talked about in the past. What would it take if we wanted to do some type of COLA increase? We need it to be at 80% or better. Which is good that we're there, but we also have to take into consideration that if we did the 80%, if we did a COLA. That would actually bring us back under the 80%. So it really positions us, we're actually getting in a stronger position where we could actually start seriously thinking about doing a COLA. But probably we couldn't do something until next year. Because I think that when the 2022 drops off, we'll be back into that mid-80s. 80, maybe 84, 85% possibly, which then will allow us to do, if we did a COLA, would still keep us above that 80% threshold. If I'm kind of reading this right.
Yeah, so a few comments on that. Again, the plan has come a long way. If we could just pull up page 6 of this report that you have up. You can see obviously it kind of was a long road. I actually started coming here in 2018. And back then, the plan was making some changes in the methods and assumptions that are used for this valuation, because like Michael said, this valuation is a budgeting tool. And what we're trying to do is make sure that assets will be available to pay all of the benefits when due to members. Because as you brought up that last slide on demographics, remember what we're here for is to pay benefits to members.
Right.
The fact that there's more money coming out than going in, you can look at that as a good thing. That's the whole point. You want to put money away so that over time you're getting more out than you're putting in. You want to pay those benefits to the members. So what we're doing here with the valuation and providing a contribution amount to the county is to make sure that assets will be available to pay those benefits in the future. And what we want to do, the methods that we use, is to help create relative stability and relative predictability for those contribution amounts, because level budgeting is key. So as we've seen kind of going back, this chart shows from 2016 through 2025, it's been increasing a lot. But what Michael just covered is that now we've kind of gotten to where we want to be. Now we are reaching a level that we do think is relatively stable coming up. Potentially could be coming down depending on investment performance. Do always keep in mind that the largest driver of this budget need will be the actual investment performance. If you keep making 17% every year, then of course your contribution needs would come down, because you can see the actual amount of investment earnings that you're getting when we saw that reconciliation is much larger than the contribution amount going in. So we have reached that relative stability. You are correct that Act 96 does require a plan to be 80% funded on this calculation in order to provide a cost of living increase to the retirees. That benefit is very valuable. And of course, by value, that means it also has a cost. So there would be a fiscal commitment from the county in order to fund that. So a couple things that would come up for what our next steps are in providing services to the plan is we will receive the asset values as of 9/30. And we will use that to prepare, generally that's available mid-October-ish. And then we'll prepare by end of October or so, some budget estimates based on those 9/30 numbers for 2027 and forward too. And that way your budget office is able to get an estimate for 2027. And then right around that time as well, the COLA information will be available. That's scheduled to be released on September 11th. So we will be able to provide what the fiscal impact would be to provide a COLA. And that would be a COLA, that measurement would be a COLA that would be effective in January of 2027. And that would increase the monthly payments to all retirees. Now, the increase would be based on the change in CPI. It's measured August to August, which is why I said it will be released September 11th. Right now, based on kind of year to date from August through now, what's been released, you're looking at about 5%, so it could be even higher. So I believe, and Michael's better with numbers than I am, but I believe if it was a 5% COLA, I think that would be an extra $20 million of liability to plan. So it would increase, of course, providing a COLA increases those benefits, right? Which increases the value of the benefits, the amount of money that you'd have to put away to fund the benefit. So the increase in value would be about $20 million to provide a 5% COLA. And if you were to pay for that over a 5-year period, which is what's provided under Act 96, that would be about $5 million increase. So you're looking at the $31 million would be like $36 million contribution. And then of course, there's the complication about, well, would that put you under the 80% funded? Would you need to kind of pay some of it ahead of time in order to make sure you still maintain the 80%? Because of course you could always put in, for example, if you put in the full 20 million, you wouldn't decrease your funded ratio at all because you'd be paying the benefit, if that makes sense. So that's what we'll be doing in the fall. We'll be able to provide the board with that information. We can certainly come back to a meeting and explain it as well, once that's available, if that's helpful.
But if we did a COLA, we're required to whatever the index comes out at, that's what we have to get, right? So if it's 5%, then that's what it has to be. Like we can't say we'll only do 3 or something like that.
So we are not attorneys. We cannot provide any interpretation of law.
One on TV.
So
But our understanding and what is most consistent, you would have to look to your solicitor, but what is most consistently been applied by the counties is as you explained. So if it comes out at say 5.6%, you can give a 5.6%. You cannot.
There is an Act 96 that has a schedule of percentages. And so the newly released percentages are what the board would have to apply. And just to level set on it, the boards can only do a COLA if we remain at 80% or above after the COLA is accounted for. So if it were to bring us below 80%, there would have to be a contribution to get it above 80%. Otherwise the COLA couldn't be done.
But what the COLA, what we have, if we do a COLA, we have to do whatever that 5%.
Correct. It's the published schedules that attach to the statute.
Yeah. And each year, one of the biggest reasons that verifies that is perennially every year, there is legislation introduced to change that, to say that the counties could provide up to that percentage. But that has never gone anywhere. And that's been going on for like 5+ years. They keep introducing it and there's never any resolution. It's always just tabled.
Okay. All right, thank you.
Thank you.
Thank you. I'd like to make a motion to adjourn the July 16th, 2026 meeting of the Montgomery County Retirement Board. Is there a second?
Second.
Second by Treasurer Salas. All in favor? Aye. Motion carries. Thanks, everyone.